All right, welcome to this week's technical breakdown. We're going to jump right in because there's a critical split happening in the market that's giving us a pretty strong signal about where risk is headed. So let's unpack it and build our game plan for the week.
Okay, so let's get right to the heart of it. The market is absolutely sending a very specific signal right now, and it all starts with this major divergence between the indices. And believe me, this isn't just random noise. It's a real potential warning sign that the internal strength of this rally is starting to crack.
So what we're looking at here is a classic SMT, or smart money technique, divergence playing out on the daily charts. It's a simple concept, really. You have correlated assets, in this case our major indices, that are supposed to move together. When one of them fails to confirm the other, well, that's a huge tell.
And here it is, plain as day. You've got the S&P and the Dow chugging along, making new highs. But look at the NASDAQ. The tech-heavy NQ is lagging behind. It's failing to make that higher high. That's the divergence right there. It tells you that the appetite for the high-growth, riskier stuff is definitely starting to fade.
For any experienced trader, this is a massive red flag. It screams internal market weakness, and more than that, it hints at distribution. Now, this isn't some big panic dump. No. This is the smart money, quietly heading for the exits, offloading their positions, while the other indices are still making things look rosy.
So all of this divergence, it's what builds our entire thesis for the week. And our core thesis is a broader risk-off environment. This isn't just a guess. It's our framework for how we're going to interpret every piece of price action we see.
So, what does a risk-off environment really mean for us traders? Well, it's pretty simple. It's that classic flight to safety. Money starts flowing out of assets like stocks and into the relative safety of the US dollar. And that relationship, weak stocks, strong dollar, is really the cornerstone of our whole outlook.
Okay, so if we're bearish on stocks, we need confirmation, right? We can't just trade one side of the story. Well, that's where the dollar index, or DXY, comes in. Think of it as the other side of the risk-off coin, and right now, it's giving us some powerful confirmation.
So taking a look at the DXY chart, what do we see? Well, first off, price is bouncing beautifully off a key bullish volume imbalance. It's treating it like a trampoline. The obvious target is up at those relative equal highs. So as long as the dollar stays above that key discount low, the path of least resistance is higher. And a rising dollar, that's going to put even more pressure on equities.
Now here's where things get really interesting. There's one major player that's just completely ignoring the risk-off memo: crude oil. Usually, a strong dollar would be a headwind for crude, but we are not in a usual environment.
The situation in the Middle East is basically throwing all the old correlations out the window. It's creating this really unique situation where fears about supply disruptions are so strong that both the dollar and crude can rally at the same time. Geopolitics is trumping everything else right now. And this chart really tells you everything you need to know about the conviction behind this oil move. The technicals are pointing to a potential breakaway gap scenario. That means the market is pricing in a powerful, sustained move higher. It's not expecting to look back. Those upside targets are very real. Okay, before we jump into our execution plan, I have to put up a huge word of caution on one particular market: silver. It might look tempting, I get it, but the underlying structure here is just risky. Extremely risky.
Honestly, there's just too much weirdness going on here. You've got whispers of potential exchange intervention, you've got speculation about a major player being trapped on the short side. This is the kind of setup where you can wake up to a price move that makes absolutely no technical sense. For our purposes, it's a market to stay away from entirely. It's just not clean.
All right, enough with the high-level view. Let's get tactical. How do we actually trade this thesis? We're going to drill down from these daily charts all the way to the 15-minute time frame, where the execution actually happens. Here's a little pro tip for you, something a lot of traders miss. If you want to find those non-obvious hidden price magnets, you've got to look at the next month futures contract. The front month shows you what everyone else is looking at, but the next month is thinner, there's less volume. And because of that, the gaps and imbalances, the real story, are so much easier to spot. They act like magnets for price. Okay, so for the NASDAQ, here's what we're looking for right at the open. Our ideal setup, our scenario A, is a gap down. Why? Because we want to see a weak little rally right back into that gap. That move up is where sellers are waiting, and that's our high probability spot to look for a short entry before the next leg lower.
Now, over on the S&P, there's a really critical level to keep your eyes on. It's this nearby bullish volume imbalance. Right now, it's acting as support, but if we trade down through it and then try to rally back,
That's when things get really interesting. That old support could flip and become a brick wall of resistance. That's a classic bearish pattern. And look, this is absolutely crucial. This whole thing is a game plan. It is not a prediction from a crystal ball. Every single trading thesis needs an invalidation point. You have to know right now, before you even think about putting on a trade, at what exact price your entire idea for the week is just plain wrong.
So this table basically pulls it all together for you. Think of it as your cheat sheet for the week. For each key asset, you've got our bias, the specific price action we're waiting to see, and, most importantly, the trigger that tells us the idea is busted and it's time to get out. This defines your risk and your opportunity.
So that really leaves you at the key question as you head into the week, right? The market is clearly showing its hand with this divergence. Are you going to position for that tech weakness now, based on this early signal, or are you going to wait for the Dow and S&P to finally confirm and roll over too? The signal is there, but as always, now it's all about execution.